I wanted to talk to you about something that came up during a conversation with a client. Um, and it's been swirling around in my own head for quite a while now. In that, so many times, during conversations with potential clients, when during the educational phase of learning about using whole life to store your cash. One of the things that we always talk about is avoiding the MEC status, modified endowment contract status. And we always say when we're showing illustrations, which you really shouldn't be showing illustrations till somebody really understands the concept, because the concept doesn't matter or the illustrations don't matter if they don't understand the concept and how it really works. So one of the things that we talk about is the MEC one and avoiding it, because there are different tax consequences with it. They're not terrible, but there's no reason to step over the line if you don't have to. And one of the things I did not know myself when I first started doing this, a number of years ago, was that you can show somebody an illustration that is not a MEC. It comes back and it's not a MEC. So you show this picture and you say, this is a snapshot in time. And that whole concept, when you think about this is just a snapshot in time, what does that really mean? That means, to me, it means as soon as you take that picture of it, like say you take a screenshot of a particular illustration, and then a month later you go back in and you put the same exact parameters, male, 40 years old, in great health, all that kind of stuff. And the numbers, the deposits you're going to put in and all this into the base and the PUA and all that are all the same. Everything's the same. Except that the death benefit may not be quite as high. Maybe it was because in that 1 month, that person went over a line in time and was closer to being the next year older, and that causes everything to change. So when you say a snapshot in time, time is the thing that changes everything, right? I mean, everything in our lives. So when you say a snapshot in time with an illustration, and that particular illustration is a non-MEC, which is what we want, and you have a premium schedule, a base premium, a PUA, if you want to put that in, and you're going along. Just say, for instance, somebody is putting in $1,000 a month the first year, but that the policy had been designed according to conversations, what you wanted to do, what the client wanted to do and was able to do. Maybe that first year they decided that they were going to put in an extra 10,000. Can you get an extra 10,000 in? We design it to do that. Then the second year, they're not going to put that second 10,000 in, but they happen to forget. So let's say the next year they can see that they're paying. Let's say that they're paying $1,000 a month, so that's $12,000 in 12 months, and the next year, they can't put that 10,000 in because of the way it was designed. I say they can't put it in without it causing MEC status. So they happen to forget. They don't look at their illustration that they signed up for, and they put that $10,000 in. And because they were underwritten for that 10,000 first year, that company accepts that money because they're underwritten for it. Now, most companies will tell you, they'll send you a letter or whatever, when a payment is going to cause that to go into a MEC status that particular year. But if you put in that extra 10,000 the second year, they accept it because it hasn't caused that policy to become a MEC that year. So they accept it. But me being the agent and wanting to have an annual review or semi-annual, I have that review with them and I run the new illustration based on what's happening today and discover that out in year 18, that policy is going to become a MEC based on the schedule of payments. You say, well, how can that happen? When I signed up and signed the contract, it wasn't a MEC. Well, that's true. It was not. At that time, that moment in time, it wasn't a MEC. But now it is because you put in that extra money that it was not scheduled to go in. But because you were underwritten for that higher amount that very first year, you can put it in. The company will accept it, not say a word. But if you look at the illustration out in year 15, 16, whatever it is, 18, it shows that this policy will become a MEC if you continue to make these payments. Now, say the third year, you decide, well, okay, so I don't have the 10,000. I'm just going to pay 2,000, my base premium, for instance. And that's all I'm going to pay. And that policy was now, instead of it being year 18 to become a MEC, it might drop down to year 20, or it might go to year 16 because they paid a larger dividend than they had expected. Because you never know what the dividend is also going to be. You don't know how profitable they are going to be year to year. When we were in a low interest rate environment for the past 20 years, they knew pretty well, they had a track record for 20 years. They knew what it was going to be like. But now that we've bumped up into these higher interest rates, and they have investments around the world, they are experiencing larger profits on these assets that they own. And therefore, they're more profitable. And they are paying bigger dividends. And the bigger dividends can push you into a next status. Which means you have to keep an eye on it. You have to have an agent that is checking your policies at least once a year. Generally, we're doing it 4 times a year. I'm checking everybody's 4 times, just to make sure. I mean, that's probably a little overkill, and maybe I don't do everybody. But anyway, so there's a number of reasons that it can become MEC, unbeknownst to us or you. And I just wanted to point that out, that the design has ramifications. So if you go and design something at a 1090, 10% to the base and 90% to the PUA, and you had a 50% or $50,000 or $10,000 dump in that first year, and that you were underwritten for that higher amount, that alone with the lower base and a bigger profitability can get you into that next status much sooner. So it might not be 18 years, it might be 8 years. It just depends. things are moving. So I guess one of the points I probably should make is that properly designed policies should be considered for what they do. So you might say, well, if that 1090, maybe they have their place, right? If you know how it works, you got to know how it works. So if you understand that, okay, the dividend became so much bigger and you were paying a higher, dump in that very first year, and now your illustration is illustrating it's going to become a MEC in 8 years. The next year, you do the same thing and their profitability is higher, say. These things can happen. And now you're at year 4. So what would you do at that point? Well, you would only pay the base premium. You wouldn't be dumping any more cash into PUAs because you would want to slow that. You would want to get some room between you and that mechanism. And this is something that I didn't understand in the very beginning when I first started doing this. And actually, the reason I came across it was that my very first client had this type of situation where the first year he put in more, and then the second year we had designed it that he was going to be putting in less, and he'd forgotten, and he kept sending in the same amount. And I caught it when we were going to do our annual review, and I was like, what is going on here? And that's when I learned how that neckline can move. It's not an exact science. It's a moving target. So say you do get up close to that and you have to lower your premiums and you can't put all the cash in that you have available, you can't store all your cash in it. What do? Well, at that time you might consider starting another branch bank. So that's not a bad thing unless you don't have insurability. In other words, you have your medical done, they draw some blood, they find out that you're sick, that something's changed. And they're not going to insure you at all, or they're going to table you at a much higher level, and it's not going to be as effective. But if you design the policies properly, that's not necessarily going to happen. And if you buy term life insurance, a separate term life insurance policy to get your human life value taken care of, that's another subject. At least with the term that is convertible, you don't have to go through underwriting to convert that into whole life. And that's another subject about how to do that. But I just wanted to touch on how policies aren't necessarily immune to ever becoming MECs, because they do. I don't think I've ever heard anybody talk about it like this. So again, working with somebody that really understands how it works is paramount to your well-being. And I guess that's about all I have to say about that. So, until next time, a snapshot in time. Here I am, a snapshot in time, and wishing you well in the new year.